Imagine for a second that you bought into what financial analysts were calling just the absolute cleverest, most innovative hotel story in the entire country.
Right, like the ultimate smart money play.
Exactly. So you do your research, you put your money down, and you feel great about it. And then,
Mhm.
I mean, you just sit there.
Yeah.
You watch your investment completely stagnate while the rest of the hospitality market is, practically doubling in value. You are basically left holding what feels like a forgotten room service tray out in the hallway while this massive party is raging next door.
It's brutal. It really is a phenomenal market mystery, though. I mean, we are looking at a massive industry boom, yet this supposed, foolproof play is severely lagging behind the pack.
And to figure out the actual mechanics behind that lag, we are pulling from a deeply researched April 2026 report. It's by Inflection Point Research, and it's titled The Curious Case of SAMHI Hotels.
Yeah, a really fantastic piece of analysis.
Totally. So our mission for this deep dive is to unpack why SAMHI Hotels, which is this company that owns the physical buildings where these world-class global brands operate, and they have this massive footprint across India, why they've been completely left behind by investors. We really need to dissect the highly unusual business model at its core. So, okay, let's unpack this because the irony here is just bothering me.
Right.
How does a structurally sound hotel company fail to thrill the public markets during what is arguably the most explosive post-pandemic travel boom in Indian history?
Well, we have to start by zooming out a bit. Before we diagnose the specific ailment keeping SAMA's stock grounded, we need to establish the macro setup.
Okay, lay it out for us.
We really need to understand why capital is aggressively chasing Indian hotels in the first place.
Right.
Because the baseline supply and demand numbers, honestly, they are almost hard to believe.
Yeah, give us the scale of the shortage here. Like, how big is the gap?
Okay, so India currently has roughly 200,000 branded hotel rooms in the entire country.
Okay, 200,000.
Right. Now, to put that in perspective, the United States has 5.5 million branded rooms.
Oh, wow.
China has nearly 4 million. And to make the bottleneck even more glaring, India has the exact same number of branded hotel rooms as Thailand.
Wait, really?
Yeah. And Thailand has 1/20th of India's population.
I want to make sure I heard that correctly. You're saying a country with over 1.4 billion people has the same room capacity as a country with 70 million people.
Exactly the same.
I mean, that isn't just a bottleneck, that is a structural vacuum.
It totally is. And that vacuum is currently colliding with this unprecedented demand boom. I mean, we are witnessing massive cultural and economic migrations right now.
Like the shift in how people are traveling, right?
Yeah, middle-income travelers are shifting away from overnight rail travel straight to domestic air travel. In just a few years, we've gone from 144 million domestic air passengers in FY19 to over 175 million today.
And obviously, every one of those new passengers landing in a new city needs a bed.
Exactly. Plus, culturally, the wedding industry is undergoing a seismic shift.
Oh, the destination weddings.
Right. Families are moving away from booking the local neighborhood banquet hall, and instead, they're block booking these massive destination resorts in places like Udaipur, Jaipur, or Goa.
Right, which eats up huge amounts of inventory.
Huge amounts. And then add the corporate sector to that. MIC travel, which is, meetings, incentives, conferences, and events, that is expanding by double digits. Corporations are finally flying hundreds of employees to 3-day offsites again.
Okay, so I have to ask the obvious question then. If demand is surging that aggressively, why aren't local real estate developers just, throwing up new hotels on every vacant lot to capture that cash?
Because the mechanics of building a hotel in India are incredibly hostile.
Really?
Yeah, the research piece actually describes it as freakishly difficult and for very good reason.
Why is that?
Well, first, acquiring clear land titles in prime urban micro-markets is prohibitively expensive. It takes forever.
Right.
Second, navigating the labyrinth of regulatory and environmental approvals, that can stall a project for years.
Just getting the permits.
Exactly. And finally, the actual construction cycle, like from pouring the foundation to actually opening the doors, that takes 3 to 5 years. So you simply cannot spin up new supply quickly to meet today's demand.
So you have surging demand hitting an absolute brick wall of supply, which brings us to the financial metric that measures that exact collision, right?
Yes, rev to beer, revenue per available room.
Yeah, and for anyone listening trying to visualize how RevPay actually functions, think of it as the hospitality version of same-store sales. in retail.
That's a great way to look at it.
Right.
Yeah.
Like if a clothing brand hasn't opened a single new store, but their total revenue goes up 10%, that growth came entirely from their existing footprint.
Exactly.
So in the hotel business, if demand is booming at, say, 10% or more, but the total supply of rooms in the city is completely stagnant, the hotels can just charge higher daily rates without losing any occupancy. That RevPR number just goes up and to the right.
Up and to the right. And we are seeing every major listed hotel group in India report high single-digit or double-digit RevPAR growth for the last 8 straight quarters.
Wow.
It is a golden era for the operators right now.
But, and this is crucial, how these companies actually absorb that golden era depends entirely on their corporate DNA, right? I mean, not all hotel companies capture that cash in the exact same way.
Oh, not at all. The organizational structure dictates everything. And broadly speaking, there are 3 distinct DNA models in the hospitality business.
Let's walk through them, because this is key to understanding SAMHI High. So, model number 1 is the legacy approach, the owner-operator.
Right, the classic model.
Yeah, this is your Indian Hotels Company Limited, which runs the Taj brand, or EIH, which runs Oberoi. In this structure, the company buys the land, they finance the massive construction, they own the physical building, and they also handle every single detail of the day-to-day operation.
Everything from hiring the executive chefs to training the concierge desk to, replacing the carpets.
Right. It is tremendously capital-intensive upfront.
Super capital intensive, but the upside is total control.
Yeah.
When a macro boom like this hits, every single rupee of increased room rates and food sales flows directly back to the company's shareholders. They do not have to share the upside with anyone.
Okay. Then you look at Model 2, which is essentially the polar opposite, the asset-light operator.
Yes.
This is the playbook that Western giants like Marriott, Hyatt, and IHG used to basically conquer the globe in the 1990s. And in India, companies like Lemon Tree are heavily pivoting to this exact structure.
Exactly. And in Model 2, the hotel company does not own the physical building at all.
They just manage it.
Right. They just manage the property for a third-party real estate owner.
Yeah.
They're purely selling their brand equity and their management software.
Which is great for them, right?
Oh, the mechanics are brilliant for their balance sheet. They charge the building owner a base management fee plus a percentage of the gross revenue. Because they aren't tying up billions of dollars in concrete and steel, their return on invested capital is spectacular. They can scale across the globe infinitely.
But there is a massive trade-off there.
A huge one. They forfeit all the real estate appreciation.
Right.
If a property in downtown Mumbai quadruples in value over 20 years, the management brand sees absolutely none of that wealth creation.
Which sets up Model 3 perfectly. The owner, not operator. The hybrid model.
Yes.
And this is the specific engine inside SAMHI Hotels. In this framework, SAMHI buys the expensive land, they pay for the construction, they carry the massive debt on their balance sheet, and they take all the depreciation hits.
Well,
But they absolutely refuse to run the actual hotel. They hand the keys over to a Marriott or a Hyatt to operate it under a global brand.
and they pay Marriott that management fee we just discussed.
You know, it really reminds me of commercial real estate. It's like the hospitality equivalent of being the landlord for a high-traffic Starbucks.
Oh, that's a perfect analogy.
Yeah, like you own the physical corner lot, you cash the incredibly steady rent checks generated by their operational genius, but you do not have to train a single barista or worry about supply chain logistics for coffee beans.
What's fascinating here is how it is just a highly efficient way to capture the best elements of both worlds.
Right.
You secure the long-term real estate appreciation of the land, and you benefit from the premium pricing power that a globally trusted brand commands.
Because the guest doesn't know the difference.
Exactly. A business traveler trusts the Marriott logo. They do not care about the name of the holding company that owns the land, but this model does create a profound vulnerability.
The debt.
The debt. The holding company still carries the massive financial risk of building the asset. They still have to service that debt.
If they are carrying all that debt, isn't that incredibly dangerous during a downturn? I mean, if travel stops, the debt payments don't.
It requires extreme financial discipline. But more importantly for our discussion today, it creates a hybrid corporate animal that the Indian public markets simply do not know how to evaluate.
Because it doesn't fit in a neat little box.
Exactly. The market understands how to value a pure real estate developer, and they know how to value a pure management brand. Mashing them together completely scrambles the traditional valuation models.
So we have this really unique Starbucks landlord playbook. Let's trace how SAMHI actually deployed it and try to uncover why the resulting stock price hit such a brutal ceiling.
The timeline is critical here. The company was founded in 2010 by Ashish Jakhanwala. And unlike many Indian hospitality leaders, he didn't inherit a legacy business empire.
He wasn't old money.
Right, he came straight from the operational trenches of the industry. And he recognized this massive structural gap. Global brands desperately wanted to plant their flags in India, but their asset-light mandates prevented them from buying the expensive land.
And on the other side,
Local Indian real estate developers sat on prime land but lacked the sophisticated expertise to run a premium hotel.
so he just found the inefficiency and stepped right into the middle of it.
He essentially became a highly specialized middleman. He began acquiring distressed, mismanaged, mid-sized hotels. Often these were vanity projects built by wealthy families who had no idea how to operate them.
Right, they just wanted to own a hotel.
Yeah, so he would buy the assets at a steep discount, inject capital to fix the physical property, and then plug a global brand into the lobby to optimize the revenue.
And the execution of that arbitrage was remarkably successful. I mean, let's look at their scale by the time they hit the public markets with their late 2023 IPO.
That's impressive.
They had 32 operating hotels, totaling nearly 5,000 rooms, or keys. This footprint was spread across 14 cities, with 76% of their portfolio strategically locked into high-demand premium markets like Bangalore, Hyderabad, Pune, and the National Capital Region.
Yeah, they weren't building out in the middle of nowhere.
Right. And they secured management partnerships with the biggest players on earth, Marriott, Hyatt, and IHG.
They quietly became the third largest hotel owner in India by room count. And they fueled that growth with heavy-hitting private equity backing from institutional titans like Goldman Sachs and Equity International.
But here is where the story stops making sense to me. Here's where it gets really interesting, actually.
Okay.
They launched their IPO in September 2023 at 126 rupees a share. Today, it hovers around 163 rupees. That is roughly a 30% return.
Which doesn't sound terrible until you look at the peers.
Exactly. Meanwhile, over that exact same window of time, the broader BSE Hotels Index practically doubled. Peer companies like IHCL literally tripled in value.
Yeah, it's a massive underperformance.
If the macro environment is historically perfect and SAMHI successfully executed this clever hybrid model to build a dominant portfolio, what is the blind spot here? I mean, a 30% return versus a 200% return from your direct peers is a staggering disconnect.
It is, and the research highlights several distinct non-fundamental reasons for this lag. The primary culprit is a mechanical market force, the private equity unwind.
Okay, walk us through how that actually suppresses a stock price. Because if a company is posting great numbers, shouldn't new buyers just snap up the shares and drive the price higher?
In theory, yes.
Yeah.
But you have to look at how a stock market order book actually functions. A stock price only appreciates when the demand from buyers outpaces the supply of shares being sold.
Basic supply and demand.
Exactly. Now, in SAMHI's case, you have early private equity backers who injected their capital way back in 2010. Private equity funds do not hold investments forever. They operate on a very strict, legally mandated clock.
Right. They have a lifespan.
Yes. They typically have a 7 to 10-year lifespan to deploy capital, grow the asset, and then liquidate it to return cash to their own investors.
So the IPO wasn't the beginning of their journey. It was their exit door.
A mandatory exit door. They aren't selling because they think SAMHI's is a failing business. They're selling because their fund structure literally demands it. Just look at the data. Foreign institutional investor ownership in SAMHI plummeted from nearly 70% in March 2024 down to roughly 44% by December 2025.
Wow. And the report notes that was about 900 crore rupees worth of stock.
It's a lot of paper.
Yeah, for anyone listening outside of India, a crore is 10 million rupees, so we are talking about roughly 110 million US dollars of equity being relentlessly dumped onto the public market over 21 months.
Think of it like trying to fill a swimming pool with a standard garden hose.
Right.
While someone else has an industrial pump draining the water out the other side.
Yeah, you're not going to fill that pool.
It doesn't matter how consistently you run that garden hose. The sheer volume of water leaving the pool completely dictates the water level. The retail buyers are the garden hose. The institutional sellers are the industrial pump. The market has to physically absorb all of that paper before the stock price can actually begin to reflect the underlying business fundamentals.
Okay, I totally understand the mechanics of forced selling. That makes sense. But that raises another question for me. If the business is this strong and the shares were being offered at a relative discount due to this technical selling pressure, why was the domestic market just sitting on its hands?
That is a great question.
Why didn't local Indian mutual funds and retail investors rush in with their own industrial pumps to buy up the supply?
That leads to the second major headwind. And this one is deeply tied to the psychology of the Indian equities market. SAMHI has what is known as an absent promoter.
Meaning there is no charismatic founder or wealthy family holding a massive controlling chunk of the equity.
Correct. SAMHI has zero promoter holding. The management team, including the CEO, holds stock entirely through employee stock ownership plans, or ESOPs.
Okay.
Now, for a Western institutional investor, a professionally managed company with zero family control often signals clean governance. It's a positive.
Sure.
But for the domestic Indian investor, it triggers a quiet alarm.
Because they are culturally conditioned to look for a different kind of safety.
Exactly. Retail investors and even mid-cap fund managers in emerging markets, they look for the gravity of a prominent family name like the Ambanis or the Birlas holding, 40% or 50% of the equity.
They want skin in the game.
Yes. That high promoter holding signals a hard-coded alignment of interests. It provides a psychological safety net. It's the belief that if the corporate ship starts taking on water, the captain is going to lose their personal fortune right alongside the retail shareholder.
Right. And without that named founder-owner narrative, there is no figurehead for retail investors to rally around on investment forums or social media.
Exactly.
A clinically efficient, institutionally backed hybrid model simply lacks the emotional resonance required to attract the massive wave of domestic capital needed to soak up all that foreign selling.
It is a textbook case of structural mechanics and market psychology, masking fundamental value.
But, to be fair to the skeptical retail investors, if you actually pull SAMHI's recent financial reports, the numbers look completely chaotic on the surface. It isn't just a lack of a charismatic founder keeping people awake.
Yeah, well, you're right. And this is the third factor that research identifies, the earnings kitchen sink.
It's a mess.
If a casual investor or a quantitative algorithm simply runs a screen on SAMHI's profit after tax over the last few quarters, the volatility is absolutely terrifying.
Let's examine those swings because they are wild. In quarter 2 of FY26, the company reported a massive 92 crore rupee profit after tax.
Which looks great.
Yeah, on paper, that looks like an incredible breakout quarter, but then you read the footnotes and you realize 84 crore of that total was a one-off legal victory regarding a land dispute in Navi Mumbai.
Right.
The actual operational profit from running hotels was a tiny fraction of the headline number.
And then, the very next quarter, the profit plummeted to just 48 crore.
Which looks like a collapse.
Exactly. But that drop wasn't because people stopped booking rooms. It was heavily distorted by a sudden change in the government's goods and services tax structure.
Wait, stop right there. The report notes the tax rate dropped from 12% down to 5%.
Yes.
I mean, a massive tax cut sounds like it should be fantastic news for a business. How on earth does a lower tax rate hurt their profit margins? I'm lost.
It is incredibly counterintuitive unless you understand how value-added taxes function in India. The crucial mechanism here is the input tax credit.
Okay.
Under the old 12% system, the hotel could essentially claim a credit for the taxes they paid on all the raw materials they purchased to run the business.
Like what?
Like cleaning supplies, lobby furniture, maintenance equipment. They could subtract the tax they paid to their vendors from the tax they owed the government.
Oh, so they were getting a rebate on their operational overhead.
Precisely. They were recovering their input costs. But when the government dropped the headline rate to 5% for the consumer, they completely eliminated that input tax credit for the hotel.
Oh, wow.
So yes, the guest pays a slightly lower tax on their room bill, but SAMHI suddenly had to absorb the full, uncredited tax cost of every single towel and bar of soap they purchased.
So their operating expenses just spiked overnight.
Overnight.
Okay, so to a lazy screener or an automated trading algorithm, that technical tax shift just looks like a company failing to manage its margins. But if we strip away the legal windfalls and the opaque tax code changes, what is the actual underlying truth of the operational business?
The underlying engine is incredibly powerful. Despite the noisy quarterly reports, their core revenue has grown at a 52% compound annual growth rate over the last 3 years.
That's huge.
They have aggressively paid down their massive debt, slashing it in half to roughly 1,450 crore rupees. And that golden metric we discussed earlier, same-store RevPAR, that grew a very healthy 13% year over year.
So the core business is absolutely humming. They're generating more revenue per room, scaling top-line growth, and deleveraging the balance sheet.
Yes.
Which brings us to the fourth and perhaps most frustrating disconnect for current shareholders, the timeline of their growth, because
Right.
their capital expenditure is aggressively backloaded.
Yeah, they have a massive pipeline of new high-margin projects, but the cash flow from those projects is years away.
Right?
The crown jewel of their pipeline is this massive 700-room dual-branded development in Navi Mumbai. It's combining a premium Westin with a Fairfield.
That's going to be a monster.
Huge. Plus, they are executing a complex conversion of a property in Hyderabad's tech hub into Marriott's ultra-luxury WA brand. And they recently acquired Rare India, which is a high-margin leisure platform.
I mean, these are moves that fundamentally alter the valuation of the company.
They are massive value creation levers.
But almost none of these projects will actually hit the profit and loss statement until 2027 or 2028.
Exactly.
If you are listening to this right now, you are probably thinking, why would I tie up my capital today in a stock that won't show its massive profit inflection for another 3 years?
Yep.
And that is exactly the trap the broader public market is falling into. So what does this all mean? It means public markets are intensely, almost pathologically impatient. In a high interest rate environment, the opportunity cost of waiting is high. Investors heavily discount future earnings.
Right.
SAMHI is building the foundation for massive growth, but because they cannot show those shiny numbers on the bottom line today, the market just shrugs and walks away.
It is classic late-cycle market behavior. Investors are perfectly willing to pay a premium for growth, but only if that growth is delivered in the current operating quarter. They have absolutely zero interest in a 2028 narrative.
And understanding that specific friction, the gap between a rapidly strengthening underlying business and a stagnant, impatient stock price, that presents a very distinct opportunity. The research piece concludes with 3 actionable frameworks for anyone analyzing this asset.
Right. And the first rule is just foundational to value investing. Check the thesis, not the price.
Expand on that. How should an investor view a 30% drop from a peak?
You have to ask yourself why you bought the asset in the first place. I mean, the thesis for buying SAMHI was never that it was a meme stock destined to double in 18 months.
Right, it's a real estate play.
The thesis was that you are acquiring an institutional-grade hotel platform during a multi-year structural supply shortage. You are betting that global operators will continue to maximize room rates, that the management will systematically pay down debt, and that their track record of turning around distressed assets will yield massive future cash flows.
And has any element of that fundamental reality changed?
Not at all. Marriott is still running the properties, the debt is substantially lower, the revenue per room continues to rise. So when the stock price drifts from a peak of 254 rupees down to the 130 to 160 range, that is not the market signaling that the underlying company is broken.
It's just a correction.
That is simply the market correcting its own initial IPO over enthusiasm.
Which flows directly into the second takeaway. Treat this equity like a corporate bond.
It is a brilliant psychological reframing.
Yeah.
You do not purchase a corporate bond expecting explosive, volatile, daily trading excitement.
No, you'd go crazy.
You buy a bond for the steady, reliable stream of cash flows over a multi-year horizon. Because SAMHI's massive growth inflection, the moment that Navi Mumbai property opens its doors and starts printing money, that is still 6 to 8 quarters away. This asset demands immense patience.
So you hold it to capture the compounding value.
You are holding it to capture the compounding value of the deleveraging and the future cash flow, not for a quick speculative flip.
Finally, takeaway number 3. Watch the institutional supply line.
Monitor the private equity unwind.
Precisely. Remember the industrial pump draining the swimming pool we talked about earlier? Eventually, that pump runs out of water.
Yeah.
Once the final concentrated blocks of foreign institutional holding are liquidated, the fundamental float dynamics of the stock will shift overnight. The artificial ceiling suppressing the order book will be lifted.
The pressure is gone.
Right. When the domestic market no longer has to absorb hundreds of millions of dollars of forced selling every single quarter, that mechanical change alone could spark a significant re-rating of the share price.
And if we connect this to the bigger picture, when you step back and look at the broader history of the Indian public markets, a distinct pattern emerges.
Which is?
The market here requires time to digest and trust novel corporate structures. We watched this exact same learning curve play out in the early 2010s with non-banking financial companies.
Oh, the NBFCs.
Right. The retail market didn't understand the model at first. They ignored it. And then suddenly the mechanics clicked and valuation skyrocketed.
Interesting.
We saw the exact same delayed reaction with specialty chemical manufacturers in the late 2010s. The market will inevitably figure out the math behind the owner-not-operator hospitality model, and when they finally do, the current discount will evaporate.
It is entirely a game of who possesses the patience to wait for the market to catch up to the math. And, that leaves us with a truly provocative question to ponder as we wrap up today.
Let's hear it.
If the public markets consistently misprice these messy hybrid business models until they experience a sudden moment of clarity, what other sectors right now are hiding massive generational value simply because they don't fit neatly into an analyst's traditional spreadsheet?
That's a great point.
Look around at other asset-heavy, brand-light industries. Think about massive private hospital networks or sprawling international school chains. These are businesses that require staggering upfront real estate capital to build, but rely entirely on a premium operational brand to drive their daily revenue.
Oh, absolutely.
Are they currently sitting in that exact same misunderstood Venn diagram? Or are they just waiting in plain sight for patient investors to figure out the mechanics and trigger a massive re-rating?
The probability is incredibly high. The public market craves clean, easily digestible narratives. When a business model is structurally complex or straddles two different sectors, human nature is to simply ignore it. But that complexity is exactly where the greatest intrinsic value is usually hidden.
And exploring that hidden value is exactly why we conduct these deep dives. Thank you for joining us to tear down the mechanics of this story. Keep questioning the surface-level financial headlines, keep hunting for those misunderstood hybrid models, and the next time you see a forgotten room service tray sitting out in the hallway, well, maybe lift the lid. You might just find a 5-star meal sitting right there, waiting for someone with enough patience to appreciate it.